Today we experienced some quite radical swings in the market. Two swings of greater than 1.5% in a single day with no catalyst. On Friday we saw the catalyst. We saw the closure of Nord Stream 1, Europe not getting gas. That sent prices down. Today we have no catalyst. We're seeing some market movement. So the way I'm seeing things is we're at an inflection point. Does this mean an inflection point up or an inflection point down? Do we put new capital to work or do we stay in cash? I'm going to run through all of this. I'm going to address positioning we have. And I have a meeting with a potential new client tomorrow. I'm going to tell you today what I'm going to tell him tomorrow morning. And if he gets on board, how we're going to act and how we're going to position and what we're going to do with that new capital, that fresh capital some of you guys might have and might be wondering what to do with. So the market overall, where do things stand? Well, ultimately, we're seeing a bear market rally unwind. We saw a bear market rally. It started June 16th. Yields topped June 14th. Oil topped June 15th. We saw the market bottom June 16th. Right now, we're seeing yields poke up. That's pulling the market back. We're seeing the Fed really hammer home some hawkishness. That's pulling the market back. We're seeing oil prices low. We'll get to that in a minute. First, more important, the Fed. It seems that every time the market has a rally, the Fed wants to hammer it back down. The market does have these powerful rallies. We had a tremendously powerful rally off the lows, erasing nearly half of the year's decline. It was the second worst start to the year in history, the worst in over 50 or some odd years, I believe. So quite a tremendous event we had to start this year, and we erased more than half of it in just a matter of weeks. And now we're getting close back to the lows. So I see very bearish and very optimistic sentiment. When we were in that bear market rally, there were a lot of people expecting us, and people I respect that I know for a fact are very smart, expecting us to get to new highs or get close to the previous highs. We have to take that off the table. That is a very difficult outlook to have right now, and in my opinion, is not very accurate, because at those levels, we were experiencing tremendously low interest rates. So if you had cash, you were guaranteed to lose money having cash or having a bond. You had to put it in stocks, and the risk reward for investing in higher risk growth stocks made more sense. Interest rates were low, cost of capital was low, those companies could raise money very easily. We have yet to see the total destruction of these stocks. Some are going to survive. I own some. I love some. I will buy some soon at some point. But as rates go up, we see things like the IPO market dry. We've seen the IPO market basically be non-existent this year. New issuance, very difficult to do because the appetite to buy new stock is lower, particularly more risky stock, much lower. So a lot of these companies that were doing well, that were talking about future products, they're going to run into this issue where they can't get more money and they're not profitable. They're operating on future profits. So they have a couple routes they can go. They can borrow money, but nobody wants to lend it to them because they have no profits. And the cost of lending alone has gone up. And the IPO market, where they can issue more stock or do whatever, raise additional capital, has dried up. So we haven't seen these kinds of bankruptcies, these collapses, these stocks at zero, et cetera, et cetera, et cetera. We haven't even seen that begin. But that is part of the Fed's agenda of raising interest rates where they are. Kashkari, formerly dovish member, just said a few weeks ago, or maybe even last week, he liked the market's reaction to to Jerome Powell's speech at Jackson Hole. So I believe it was last week. I believe. The Fed is telling us they want to mark it down. Why do they want to mark it down? Because the market up increases people's net worths, gives them extra cash, everyone's feeling good, everyone's buying homes, everyone's buying cars, everyone's spending money, everyone's borrowing against stock. They don't want that. That time has happened. It is now fading away. And things, in my opinion, are going to get a lot worse before they get better. Now, they might get better short term. So now we'll get to the new capital thing in a second, but I'm just going to address why things might get better short term. CPI next week is probably not going to be catastrophic. I don't think I've noticed prices going up tremendously. Gas prices have obviously calmed down. But while things might get better in the short term, I think the more moderate, medium-term outlook is continuing to disintegrate. The European energy crisis is not getting better. It's getting worse, and it might continue to get worse. So I expect oil prices to recover and go back up. Short term, there might be recession fears. Strategic Petroleum Reserve Strategic Midterm Reserve is currently until the end of October in its most intense withdrawal phase. So this is the most intense it's going to be next 2 months, and then it's going to vanish. And then it's going to be winter. And then it's going to be OPEC production cuts. And guess what? That is going to be a much more fruitful period for oil prices. So we might get a second wave of inflation come that time. So while the near term might see inflation fall, gas prices fall, these kinds of things, the longer term is less clear. It's much more hazy. And I think things might get worse before they get better. And I think, Mike Wilson, the bear of 2022, brought up a good point. Raising interest rates, it's meant to do something. It's not meant to send stocks down. It's meant to constrict borrowing, constrict spending, have an impact on the economy. The economy is still strong. It's showing signs of weakness, but it's still strong. We still need to see the impacts of that tightening. And the Fed has laid on multiple impacts that they forecast and will be comfortable seeing. That is a meaningful rise in unemployment. Okay? Don't expect the Fed to begin to ease once unemployment ticks up. Okay? This is not true. They're going to be fine, if not happy, with unemployment ticking up. So that's going to be a negative impact on the economy. Might be good that wages come down or something, but you get what I'm saying. It's not a rosy picture. So the economy is basically destined to get weaker. The Fed has also said that they expect the impacts of their tightening to take months to come to fruition. So what they do now is we're still going to see that effect, some 3 to 6 months at least from now. And they've done some stuff. They're going to continue to tighten. So things are going to be happening. We got to acknowledge this. We can't be phased by a week or 2 week or even 3 week long bull market. Okay? So we can try to play it if things are getting a little oversold. And that leads me into my next point. Okay? Don't get too excited about playing things. But next point. So I've got this meeting with a potential client tomorrow who might be putting money in, and he's going to want some clarity on what I'm going to do with that money. He wants a game plan. He wants some clarity, He wants to know. Why not? Why wouldn't he want to know? My thought process on this, and I've had new clients come with fresh money, zero anything, and zero positions in the account. If you look at the Leftskewed Investment Management historical performance, and you go to the very beginning of that chart, that was when I got my second client, moved from trading inside somebody's account to combining two accounts. One of the accounts transferred its positions, the other came in all cash. The market has this run-up, and we stay rather flat. And then that run-up has this pullback, and then we participate. As I said, inflection point. Is an inflection point up? Is an inflection point down? Hard to say. I've laid out the reasons why I think things are down. More prolonged time frame. But in the short run, we've seen already a strong pullback. So the odds of a bounce are quite high. I don't want to buy at the bottom of the pullback before the bounce, right? So with that fresh capital, guess what I'm doing? I'm remaining patient. I'm waiting for the market to make its move. Almost like you're a point guard or a soccer player and the defense is coming up on you and you're running. Quick hesitation, get the defense to, flip, jolt, whatever, break their ankles, and then make your move. So the market rallies, let's say oversold bounce, up to 4,100 range. I know to fade that. I know to get bearish, and I know to put on some downside protection, and I will do that. Say the market continues to drop, I'll continue to sit. If energy continues to drop, I'll buy some energy. If the market continues to drop, maybe I'll begin to look for a bounce. That is how I'm thinking about things. Fresh capital right now, nothing wrong with cash at this moment, even in this time frame. So, hesitation, try to break their ankles, see what happens, and then we'll go from there and we'll be talking when it's time. So that's today's video. And until next time, peace out.